right, well, welcome to the May Economic Update. I'm John Cleaver, partner, advisor at Beyond Wealth Advisors.
I'm Dennis Bacon, Chief Investment Officer at Beyond Wealth Advisors.
Well, we're glad to be back. It's almost summer.
90 degrees next week.
90 degrees next week. So there's just been a little bit going on in the market and the economy. Let's just jump right in, right?
Okay.
So it feels like we've been kind of treading water a little bit. Things look good one day, maybe pull back the next day. And I'm not sure if that means we're on the precipice of something good or something bad. So what do you see?
That's the multi-billion-dollar question.
That's right.
I think on the positive, there's kind of a positive side and negative side of this first part. The consumer is pretty much driving this economy. Consumer services are up. People are going out and doing things more in the service industry. Consumer discretionary is up 15%.
Right.
And information technology is up 21%. That's driven by just a few stocks, though. Now, why I say that's a good to bad is because if the consumer ever stops spending, it can be a problem. It can be a problem. Europe is up year to date 15%, while the U.S. is up 8%, and the overall worldwide average is about 7%. On the stock market, so that's good. Yields on bonds are up a lot, so it helps the savers, which is great. That part's really good, but kind of a not so good side. We haven't really talked a lot about gross domestic product, which is basically the total output of our economy. While it did go up in the first quarter, it went up at an annualized rate of just slightly over 1.1%, but that means 0.25% for the quarter. So not really a lot. And that's a slowdown from over 2%, almost 3% in the prior quarter. Unemployment has been doggedly hanging around 3.5. Actually, just this morning we got another report that had a surprise new jobs on the upside, but they had a revision of February and March on the downside. So while at the surface it looks good, it really means maybe the estimates in the prior months were not as good, and we don't know what the estimates on this could get downgraded to. The general feeling of that is because a lot of the large tech companies that are making profits have also had layoffs, which have helped their profits because they have less people working. Some of them are very significant. I mean, we all know that Twitter had almost 80% of their sales, 80% of their employment force reduced, but yet it still seems like people are tweeting. So it kind of seems to continue to go on. On the negative side, consumer confidence is, while still positive, has been trending negative. On the worldwide, manufacturing continues to slip into a contraction mode. China has been kind of vacillating between contraction and expansion. It's now in a contraction mode. So there's just a lot of things out there that, with the exception of the U.S. consumer, Europe is a big rebound. They haven't really had a rebound since COVID, so this was kind of expected for them, but that's good news. But it's kind of a mixed bag right now, to be honest with you.
Right. So when we dive in a little deeper and we kind of read the bond market, we might get the sense that maybe we're ready for a pullback, maybe a little bit of recession per se. But you look at the equity side, and we've actually had a pretty good run to start the year. We're certainly positive and have had an upward trend. So how are equities kind of bucking the trend, so to speak?
Well, let me kind of go to the bond side of it, which is spot on that. It's actually, this is one of the most inverted yield curves we have had.
Explain that. What does that mean?
That means long bonds, when you go out and buy a 10-year bond, you get less interest on that than if you buy something that's a year long. So money market rates are hovering around 5% right now, and yet the 10-year Treasury is hovering somewhere around 3.5. That's not typical, and it's not always a precursor to a recession, but often, if you've had a recession, we've probably had this environment. So it's that gives some real concern on that side. On the stock market side, the indexes are up a lot. As we said, information technology is 21%. This is driven largely by about 5 or 6 stocks. One major company announced this morning that they had a surprise upside to the earnings, so the market's up 300 or 400 points as we're making this recording. But if we look at the broader market, It's not that way.
Right.
So there's a good and a bad to that. If we do have a recessionary or a declining in growth to where we kind of stagnate in the economy, all those other companies that haven't expanded their price are probably okay. I mean, there may be
Right.
some drop. A lot of economists are forecasting a drop of somewhere around 10 to 15% at some time over the next several months. I'm thinking late summer at this point, but nobody can really predict it. But that's kind of what most of the economists, we just got back from our national conference, and that's what I heard from virtually all. I think I had one economist that didn't think that, that I listened to, and I listened to 4 or 5 of them during that 2 or 3 days. So
Right.
it's still a mixed bag. It's tending to look like we're going to have a drawdown in the market, though, by everything that I see. Not long term, but it should be a drawdown.
So that kind of begs the question, if those, half dozen or so tech stocks that are really driving kind of the equity recovery, we get a little pullback, are we going to have a little bit of a tech bubble bursting here?
I don't really think so. It may be the case for some of the large companies that are their earnings, their price earnings ratio is inflated, which would be typical. There's always some that do that.
Right.
I don't really see that being a major deal on the broad market, and the length of the negative environment. Typically, it runs from 6 to 12 months. You pick a number in there. I would expect that this will be that same case.
Right.
We may have a slow come out. I don't know. We may have a quick rebound. It just really is hard to predict at this point. It really a lot depends on what happens with the consumer and just what the overall sentiment is. So I really not. I've been doing this for over 30 years, and managing people's assets for that time, and I really don't see this as being that untypical. It always looks different. It always
Each
looks
one
different.
looks different, for sure.
But I don't look at it being, I'm not overly concerned. Don't know what the backside looks like, but I think it'll be positive, but I don't know how much.
So it feels like this is an opportunity to remain diversified and really be across a broader spectrum, particularly on the equity side. Also an opportunity maybe to have a little more cash. We might call that some dry powder sitting on the dock that could be deployed maybe at some point in the future. And I guess right now you could actually get rewarded a little bit for holding some of that cash on the sideline because of money market rates.
It hasn't been the case for about 15 years, 10 or 15 years, that we're actually making some money by holding some cash. And I think that's really important, that you're actually making something while it's sitting there. We want to make sure, I think it's important that you make sure that you're within your risk tolerance level and stay within that. I would lean into the conservative side of it right now, but this is not a big time to make big bets.
Right. Yeah, so such an important point. Identify that investment objective, identify that timeline, that time horizon we often talk about, and then ultimately, where's the real risk tolerance? These are times in the market where sometimes our risk tolerance gets tested a little bit, right? So that's a great opportunity to schedule that review, have that phone call, get with your advisor, really talk through and think through, kind of what your needs are right now, 6 months, 9 months, maybe even 2, 3 years down the road, and then stay committed to that discipline, and don't get too sideways with everything that's going on in the media.
Right. If you plan properly for your cash flows and you've always managed for those, and if you're going to need money over the next 6 months to a year, you should already have that in position so that it's not at high risk.
Right. Fantastic. All right. Well, with that, we're going to wrap up what is the month of May's economic update, and we'll look forward to seeing you back in June.
That's great. Y'all have a great beginning to summer.